whilst I know the fear is real, I think that a lot of it has been mitigated. We don't give funds to a particular project. We invest through instruments that are usually liquid.
Yes.
And every PFA will assess, the investment thesis behind it to ensure that, look, is this thing that we're investing in. If I'm going to buy a corporate bond, for instance, so we invest in, multinationals, the biggest blue chip companies, the telcos, the big cement companies, the big banks and everything. So the things you want to look at are these viable entities. If you invest in them, will they be able to generate returns? So if it's a corporate bond, will that person, is it credit worthy? To be able to pay back the money and pay the coupons on those things. If it's equity, will they continue to grow revenue and profitability over time so that, through dividends and capital appreciation? And we know that the markets behave in cycles. Sometimes now globally there's, risk off. But generally speaking, over the long term, those things tend to return. So, but you wouldn't invest in untested businesses. A lot of times, there are even rating requirements for certain instruments before you can even, invest in it. But that does not absolve the investment house from doing their due diligence. So it's misplaced that, look, you're going to hand some, whether it's state government. So for instance, states also come out with issuances. We have a rating criteria for each state as well. If we think the state has the capacity to pay, the industry will lend them the money. We will take the credit risk of that. Where we think that the state is not viable, maybe they are struggling with salaries or struggling with things like that, then you'll be a bit, reticent to say they're already overburdened, and would they apply the money based on the things? And, you even look at it, what do they want to use the money for? If it's for recurrent expenditure, like to pay salaries or our pensions arrears, then you are worried. There has to be something to do, productive. So, for instance, we've been big partakers in government sukuk bonds, for instance, which we see that have used to build roads, across the federation. And so those are the things, productive assets, because at the end of the day, you want to see pension also adding value to the Nigerian economy, and so that we're partners in progress. So, but the promise is that you've contributed your money. When you retire, you can start to get your pension and live, your retirement in dignity.
Great. When you retire, you can ensure that you can live in dignity. I like that.
Yeah.
Something I've always heard said is that, when you invest in government bonds, they're the safest form of local currency investment. Can you speak to that? What does that mean when you say investing in government bonds or bills are the safest form of local currency investment?
So the federal government in our case is the sovereign. And so they have the capacity to print money essentially. So they are the safest one, and for the entire history of this country, Nigerian federal government has never defaulted on its obligation. So that we are saying that the capacity of the government to pay, the federal government now, because we have state governments, we have local governments, that are wherewithal, so locally they are rated AAA because they've never defaulted and they will always miss their obligations one way or the other. So we, despite the fact, and one thing I learned very early in my career, that diversification, is the only free lunch you get in investment management. That's the only free lunch. Otherwise, everything else you pay. So despite the fact that that is the safest guide, there are even limits and parameters to ensure that we don't put all the eggs in one basket. Because look, there are no guarantees in the world, as you know. And the only thing constant in life is change. So despite the fact, you don't want to wake up one day and hear that, the federal government will. So despite that, we ensure that we allocate across various things. You take some corporate bonds, you take some treasury bills, you take some equities, you do a bit of private equity, you do a bit of infrastructure. So you just want to mix and match within that capacity.